Hello, and welcome to The Rare Agent, where we pull back the curtain on all things real estate. We're your hosts, Christina, Mary Jo, and Murray, offering up a judgment-free zone for collaboration over competition. We would love to welcome today's guest. She's the owner-founder of Castle Mark Wealth, Robyn Thompson. Today, we are diving deep into her journey, uncovering the wisdom and experience that has shaped her into the powerhouse she is today. Thank you for being on the show.
Welcome. Powerhouse. Wow, that's a really big intro.
You are a powerhouse.
Yeah.
Lots of shoes to fill there in 45 minutes.
Yeah, it's impressive. Like we're very impressed when we see a female who's come through as much as you have and done as much as you have. So
and educate as much as you do, even through your own websites, your social media, or your being in the media on news channels. I think it's lovely.
I mean, I think financial literacy and education, whether it be in real estate or whether it be in finance, is important. I mean, I think that, the more that you know and the more literate you are in different areas and the more you have in your wheelhouse to be able to make different decisions for your future. So I'm all about financial literacy. I also volunteer with JA. I love JA, Junior Achievement.
Okay.
So I go into schools and essentially teach children about dollars and cents as the program I teach. So
financial literacy.
You. So if you can, if you can help people in the sort of different phases in life, it makes a huge difference.
It's something that's missing in our school system. Mm-hmm. Like kids are not getting it. So that's amazing that
they don't get it. And then when they go into post-secondary, the first tables that are set up in the school is sign up for this credit card. Mm-hmm. You get a credit card, you're instantly approved. And then these kids just start using credit cards. And
they think that money is magic. You know, it just happens to appear there. They don't.
Wouldn't that be nice? Wouldn't it be nice? That would be really nice, right? I think we'll all take a little bit of magic money, right?
Oh yeah. I mean, unfortunately, you have to pay it back at some point. That's the part that they don't get.
That's why it's not so magical.
Yeah. What got you into this business?
Well, I started off in journalism. So I was actually a journalist. I was a co-anchor and a co-producer for an investment television show that aired on Global. And I was someone who talked a lot about finances to the end of a camera. And I couldn't really see, if the information that I was giving to people were actually using. So at some point, it's like, is the information being received? Is it being delivered? And are people actually taking the recommendations of the experts and the guests into their lives and creating wealth for themselves? So throughout that journey, I started to interview some of the people I would interview on the different shows. And I decided that, I actually wanted to make the leap into someone who manages wealth versus someone who just interviews on it and just talks about it. And that was really kind of my entry into the wealth management business, was actually through someone I used to interview on one of my shows.
Oh, wow. How long ago was that?
Oh, goodness, you're going to date me here. So I think we're probably going back close to 18, 19 years now.
Oh, wow.
Mm-hmm.
And that led you into your own business.
So Castle Mark Wealth Management's 12 years old, but I've been in the investment business probably about 17, 18 years around there, close to a decade. So I first started as again with this first gentleman, and I was his relationship manager, and I went to school on nights and on weekends to obtain the different licenses I need to be able to give people financial advice. Obviously, the more licensing you have, the designations you have, the more qualified you are to help people with their money. And helping people with their money is very important. So I think you need to be very credentialed in order to do that. So I did that on the nights and weekends, I think for over 8 years. And then 12 years ago, I opened up Castle Mark Wealth Management.
Wow.
Mm-hmm.
I think you need to help me with my money.
Sure, no problem.
In our heads, we're all thinking the same thing.
As a realtor, it's really difficult to manage your money at times if you don't really know the ins and outs of financing, because our income is commission based, right? So there's
100%.
Yeah, it's like it's feast or famine, right? So you have to be prepared for those times that are not as busy, or that it's more challenging, or something happens in your life. I had a mentor who bothered me forever to start to get RSPs going, and now I've kind of shifted from that mentality, but for different times in your life, different things work, right?
Mm-hmm.
But just even to start thinking about how to structure your finances in order to be able to support yourself and your family if you're not making as much money as you're used to.
When you're not a salary, right? Like we're not a salary, so it's like, okay, you can have a really great couple of months and then nothing.
Mm-hmm.
So, and a lot of realtors don't know how to manage their money. They don't know how to manage their expenses. And then when they come to that point when they're not making any money, it's panic. And you don't want to be selling in panic. It's not the way.
If you have somebody that's coming to you in this scenario, what would be your first what would be your first thing advice to them? What would be the first thing that they would do?
Well, I think the first thing is to actually recognize that your business, it's not only a cyclical business, like it does have its seasonality to it, but it's also heavily impacted by macroeconomic factors, right? So interest rate announcements, changes, things that happen in the broader economy trickle down into the world of real estate. So what that means is that, like you said, where you don't have a steady paycheck, you could, it could be where there's tumbleweeds rolling around in the backyard, or there's more business than you can handle. So you go through either one or two extremes generally. You either have a really big pipeline or you're scarce in your pipeline. And what I find recently is that, realtors have gone through a very volatile market. And they've seen that where they haven't closed a sale in 3 to 6 months. They're not going to get paid for another 3 months after closing. So if they haven't done the job or the work to create enough of an emergency fund or enough of a cash wedge to be able to have them sustain themselves through those down periods, they find themselves, like you said, doing the worst thing possible, which is selling in panic. Whether you're selling real estate in panic, whether you're selling investments in panic, anything with the word panic and investment or real estate attached to it, or in life, is not the ideal situation, because that's the worst time that you want to be selling something. So if you want to protect your assets, whether that be your real estate assets or your investable assets, you need to make sure that you're doing the homework up front. And there's a few things you can do to be able to start to create that. But I think what I find sometimes with real estate agents is that they don't, and this is generality. So obviously I'm not painting everyone with the same brush, but you get these, massive commission checks, especially if you live in large city centers. And, not all of that is your money. I mean, part of this is HST. Part of this is income tax. Part of this is marketing for your business for the future. Yeah. Part of this is to pay yourself first. I mean, it's not to go out and just be like, oh my gosh, look at this amazing huge check. Look how much money I've made. I mean, you know how much good you can do if you reinvested that, and you reinvested it either into an account that saves and builds for your retirement, such as an RSP or tax-free savings account, or into additional real estate investments. So it's about looking at your money coming in and understanding what is the purpose of this money, and how do I structure it so that I win at the end of the day. Because your business, as much as people think real estate is a transaction-based business, it's really a service-based business.
100%.
This is about servicing your customers. And if you do that well, the business that you build will be sellable in the future. But if you treat it like a transaction ATM, that's exactly what you're going to get.
Exactly.
And eventually the machine's going to stop giving you money because you haven't created the structure for your business to be able to succeed. So
you have to run it like a business. And I think that's the misconception that people just don't understand. It's exactly what you said, like a paycheck should be organized in the way that okay, this is how much I have to allocate towards my expenses and so on. And most people
know your expenses.
And know your expenses. And most people, most realtors do not do that. They have no idea.
Yeah, I mean, I would say that, if we can make that umbrella larger than realtors. A significant amount of people don't really have a clear understanding of what all of their expenses are.
Essentially.
And I think that especially in these times with high inflation and high interest rates, I mean, people's disposable income has been squashed. So people are often spending beyond their means right now because they need to. They need to be able to put food on the table. They need to pay their variable rate mortgages at a high interest rates. Listen, I have a variable rate mortgage on all 3 of my properties, and variable rate mortgages have consistently, always historically been the better bet. So,
but this is not something we've seen.
Yeah, exactly. You're not seeing. So that's the thing, is that if you're not prepared for those kind of changes, then you need to be clear on what is my ability to be able to handle things in the market that I can't see. What is my if something's going to go offside, eventually something will go offside. I mean, that pendulum's going to swing to both sides. So you need to be able to try to make sure that you have enough in your padding to be able to weather those storms, whether it be a variable rate mortgage, whether it be, God forbid, the death or sickness of someone. As realtors, as entrepreneurs, I mean, you're responsible for your own healthcare. You're responsible for your own pensions. Exactly. So things like disability insurance. If you were to become disabled, who's going to pay your bills if you don't go to work?
Exactly. We don't get benefits.
Exactly. If you get sick and you were diagnosed with cancer, like I was last year, and I'm an entrepreneur, who pays my bills? Well, I'm in the insurance business, so I had my own CI policy on myself. But some things that people don't think about for themselves as an entrepreneur, especially real estate agents, is when you don't go to work, no one gets paid. Yeah. So what happens if you can't go to work? So there's all these different levels of how you start to build your wealth, how you start to build your business, how do you protect your wealth, and then how do you protect yourself that if something does happen to you, money's still coming in.
That's the key, is protecting your wealth. But how did you put an insurance policy on yourself? I'm very curious about that.
Well, I'm a licensed insurance person, so I do have a licensed insurance agent. I'm a licensed insurance agent, rather. So I did a CI policy, but I did it back like 20 years ago. So really young. So when it comes to insurance, the younger you are, the healthier you are, the cheaper the insurance.
And then you can just keep it.
And then you keep it. I don't have it anymore because once they pay your CI claim, they don't let you keep the policy anymore.
Okay.
But it's about, if you're a younger person listening to this podcast, or you're not a younger person and you're somewhere in the middle age, take a look at all the things you need to do to not just build your wealth, but to protect your wealth. Because things happen, as you mentioned. Nobody saw this environment coming. No one saw these interest rate hikes, but nobody saw the financial crisis. Nobody saw the .com, bubble. Nobody saw any of those things.
Yeah.
That's why they call them black swan events, is because they're rare. But when they happen, they tend to take you off at the knees.
Yeah.
So as realtors, putting some structure in place around, what are my expenses? It doesn't have to be overly complicated. Take out an Excel spreadsheet, take out a piece of paper, write everything down.
Yeah.
You can even track it on your bank account now. So they track it on your accounts,
There's
your debit
so many
card, or your
programs
credit
that
card.
allow you to do this.
Take a look at it. What's coming in? Like what's going out, what's coming in. And when you take a look at the income you have coming in, you should at least have 3 to 6 months worth of expenses to be able to pay your rent or your mortgage or your necessity costs without anything else. Like, yes, I know debt's difficult right now, especially if you're in variable rate mortgages. If you haven't been able to manage your own credit cards at 19% interest rate. So you're legitimately getting hammered from every side.
Yeah.
Groceries are expensive. Everything is expensive. It's important to note that this will not last forever. It's just for now, but you need to be able to manage for now. So if you're in that situation, you make sure you're paying your highest interest rate credit cards first, your 19%, and then put the rest towards an emergency savings so that you have enough to weather through periods of uncertainty. You guys are going into the winter. The winter market's not the best market for realtors generally.
Fall market's usually like the second
Fall is good,
biggest.
yeah. And then getting into the winter market, but that's what I mean, right?
This is a low winter, like a fall.
It's a low fall,
yeah.
But fall and spring are usually your hot markets.
Yeah.
So as we're looking at winter, because anything now is not closing until December, January, right?
Right, yeah.
And
If
then
we don't
you're
get before Christmas,
and then you're quarterly, right? So you guys are always so far ahead of paycheck, even when you close a deal. It's about looking at the larger picture, saying, where am I in 6, 9, 12 months from now? Because a short-term view isn't long enough.
Yeah.
Because it could be months before you close another, or you're selling them like hotcakes. And if that's you, oh my God, you can call me. I'll manage your money for you.
Yes, please. Yes, please. I'm calling you. For me personally, what takes the stress off is I have a property that has 4 units. So I don't have just one source of income because of times like this. I'm a single mom. So I have to make sure it's just single income, right? So I have to make sure I have other ways to
Passive income.
Yeah, passive income. So that kind of takes the edge off a little bit. And then I liked what you said about paying yourself. Once we opened our corporation, it changes your perspective. Like, this is not just all my money, so you're taking a percentage of that and you're paying yourself. So you're making a salary. So just changing the way you think about it has helped me personally. Whoops.
What is your take on corporations for realtors?
Yeah, I mean, you have the PREC, right, which is obviously a corporation for a realtor or for a broker. And I think it depends on where you are in the real estate journey. If you are a new agent and you're not making a significant amount of sales or a significant amount of clients yet, you do have to pay incorporation fees. You have to pay, you have to do annual filing fees. You have to hire an accountant to do all your statements. So it gets a little bit
pricey.
More pricier if you're not an agent who's making a certain level of amount. Usually, I think in private corporations, usually that's anytime between 30 and 60,000. Anything above that, you probably want to look at incorporation. But it depends on what your lifestyle looks like. I mean, a corporation is a great way for you to be able to benefit from taxes, right? The entire idea of a corporation is to figure out how to manage your taxes at the most appropriate level. So you pay yourself a dividend or you pay yourself a salary. If you pay yourself a salary, then you start to accumulate, RSP room, you start to accumulate different benefits. So I think it's about understanding what is the purpose of the corporation. If it is to manage your taxes, I think it's amazing. If it's to set up a structure for you as a realtor to be able to say, my money's coming in here, this is how I piece out my HST, so I piece up my tax. This is how I pay myself. This is how I put money back into my business. Some people really look at business and corporations as silos, right? So what is the silo that I have here? Like, what is the different? And most people work in silos, I mean, myself included. And in a corporation, it feels more structured Because when you're on your own as an entrepreneur, everything comes into one account, and then you have to say, okay, well, I'm going to move this to my savings, or I'm going to move this to my secondary savings, or this to my travel, or this to my marketing. And I think in a corporation, it gives you the structure to be able to manage the tax efficiently. It also gives you the opportunity to be able to take a look at your investments and have them grow. A PREC is a great place to have investable assets.
Yeah.
Any excess cash flow that you have should be invested into the equity markets.
For our people that maybe don't really know, what is a PREC?
Oh, a PREC? Oh, it's
Yeah.
Essentially it's a professional real estate corporation.
Perfect.
Yes.
Sometimes because our
And what's the
non-realtor
silo?
phone-
Is it just me? What's the silo?
So silo is more like it's not a silo is it's not an official term. It's kind of like I think that we compartmentalize things, right? So a silo is essentially a compartment that you see within your brain. So in your business, you would have
That's how my brain works.
Yeah.
Silo.
it's not like it has little it has tranches, right? So you'd be like, okay, so in the corporation, once your money hits there, you take this much, say, okay, this is going to HST, it goes into your HST account. This is what I need to pay in corporate taxes. This goes into my corporate tax account. This is what I need for marketing. It's going to go into my, your operating account. This is what I'm not spending, and this extra $1 million or $2 million that you have in your PREC needs to be invested in the capital markets. You don't want to have your investments sitting there
And you can
not
send it
earning
through
a
your
rate of
corporation
return.
as well.
You invest inside your corporation.
Yeah.
So, I mean, I have lots of clients that have PRECs. So when you do that, what you're doing is you're investing inside your professional real estate corporation. And you can decide how much risk you want to take. You could even buy fixed or fixed income securities, cash or cash equivalent. So you could hold GICs if you want. But generally, you like to look at equities. So you're looking at stocks, bonds, ETFs, mutual funds. The last thing you want to do is have your money sitting there not doing anything for you.
Yeah. Wow. Where I'm like, okay, there's a lot going on there.
We're just very excited.
I get very excited about this kind of stuff. It makes me really happy.
Yeah, so let me give you an example then, just around what it means from a time perspective, because I think that sometimes people think, oh, well, I'm making big chunks of money and I'll just put in a big chunk of money later on. And if I put a big chunk of money later on, and it's going to grow for me and it's going to generate enough money for you to retire. So if you're thinking about investing, I mean, the earlier you start investing, the more you'll have at the end of the day, right? It's about the time that you have invested in the market. It's not that different than the real estate market. So if you were to buy a property 15 years ago, what would it be worth today, right? So similar when it comes to investing in the equity markets, if you were to start with, say, $10,000 and you were to put $12,000 a year, and you did that at 7% return rate, which is in line with the balanced historical rate of return on the S&P TSX, which is the Canadian Stock Market Index.
It's like 6 to 7%, right?
And
roughly?
you did that, and you did that for 30 years, you'd have about $1.26 million.
After how many years?
After 30.
After 30 years.
But if you only did it for 20 years, you'd have about 500,000, just over 500,000. So that difference of 10 years makes a significant difference.
Yeah.
So
It's
the
so
sooner,
wild to
the
think that
sooner
10
you
years.
start, even if they're small amounts.
That's important, I think, for young listeners,
Yeah.
because there's a lot of young realtors getting in and thinking, you know what, I'll never.
I don't have the
be-
money to invest either.
Yeah,
You
I have
go,
no money to save.
go.
I can't afford it. But I mean, even if you start small,
It's the small amounts that
Yeah.
build over time. Truthfully, all things that we do in life, it's about the small amounts that compound and grow time year over year over year. And whether that be real estate or whether it be equities is the same. I mean, I am someone who manages wealth for a living, and half my portfolio is in real estate. Real estate is a great asset class. I mean, it keeps up beyond the rate of inflation. It's a hard asset. I like to generate passive income, and I like the idea of being able to have diversification in my portfolio. So I think that looking outside of real estate is important for realtors, because real estate is not a liquid asset class. You know, if you need access to that capital, they're borrowing against it at very high rates, or you're selling it in a market that may not be the most preferable market. So it's about making sure that you have accessibility to capital, liquidity, in times where you need it, or in times where you want to be able to choose something different with your life, whether your kids are going to school, whether you're going through a divorce, whether you want to open a brokerage or whatever it may be. Having all your things in one place or all your eggs in one basket is generally not a good idea. So just make sure you have some diversification. Real estate, equities, stocks, ETFs, things like
I
that.
think all of us will be calling you after this.
Mine is just not only depending on selling real estate. I would like to really start getting my assets into a place or building them so I don't only have to depend on like the big chunk of my finances on selling a house or not selling a house. I'd like to really get there, and it's something that I'm really working on.
Well, the idea in all areas, I think, is really about And with clients, I sit down and the goal at the end of the day, if it's retirement, you want to earn enough off of your investments to replace your income, right? So you need enough money in investable assets, whether it be real estate with passive income coming in or the equity markets. Your portfolio needs to be a large enough size so it's generating enough in distributions and rents and dividends to pay you your 150 grand or 200 a year or however much money you want to make. Once you have that built up, then that pays itself. So it's about building in the future so you can get to a point where your business or your assets generate enough income to replace the income you have while you're out working. Because eventually you're not always going to be working. So you need to find a way to generate that kind of income, which means you need to invest now for it to grow to generate that income. And whether that's sitting in an investment property that's being paid off with a mortgage by someone else paying off your mortgage, whether it's investing inside of investments. Again, I think that the other part of that is taking a look at the taxation. So if you look at investment properties, any investment property you have will be, it goes through the, capital gains rate. So 50% capital gains rate, and you'll pay tax on the ACB or the difference between your purchase price and what you sold it at. So you don't walk away with the full value because you have to pay tax on your profit.
There's ways around that, though.
Yeah. So I think that when you look at, how you're holding it, the structure you're holding it, I'm going to say right now, make sure you speak to a lawyer.
Yeah.
Disclaimer.
Yeah, I'm not a lawyer, so I'm only here to look at it and say, how you manage what that looks like. Your principal residence obviously is tax exempt.
For now.
For now. But, listen, I've heard them float 75%, capital gains inclusion rate. I've heard them that they're going to tax principal residence.
How much more tax can they put on
This is all
though?
hearsay. At the end of the day, it's all hearsay. And we are just, clogs in the wheel. We're just watching go around. There's anything that we're going to say, it means a collective voice will be heard. But really, we have to make sure we're following that sort of line. But then when you look at investable assets, they also have preferential tax treatment to them. So there's capital gains, dividends obviously on them. There's interest, rent. So every different investment or different security, some of them have different taxation structures to them. And one of the best accounts that you can invest in right now is a tax-free savings account.
I was going to ask you about that.
So tax-free savings account, if you haven't invested in that, this is probably one of the gifts that we'll receive from the government if we ever to receive gifts. And it's because a tax-free savings account, it sounds like, as it is, it's an account that's tax-free. So any money that grows inside the tax-free savings account comes out completely free to you, tax-free on the other end. So right now, if you've never contributed, you have $88,000 you can contribute into it. Grows by about $6,500 a year is what you can put into it every year.
But $88,000 total?
Yeah, so $88,000 total since inception if you haven't contributed, and then you can put $6,500 a year. So the next calendar year will start the next $6,500. But any capital that money essentially earns comes out completely tax-free for you at the end. So if you have that growing for 10 or 15 or 20 years, and you have an investment that's growing at 8, 9, 10%, that number is going to jump significantly because at the end of the day, your wealth is what you take home after taxes, after fees. It's net, net, net. So if you can structure your life and your practice, whether it be inside a PREC for tax purposes,
I was going to say, can
whether
you put
it be
it
a tax-free
inside?
No.
You can't.
Tax-free savings account has to be outside.
Okay.
But you can have a PREC and you can have a tax-free savings account for yourself. You can have an RSP and you can have non-registered accounts. So you have to make sure that you're taking advantage of the different tax structures that are available to you to make sure that you're keeping as much money as you can, having as much money go tax deferred. And at the end of the day, when you take it out, you don't lose half of it to the government. So tax
do you work in
strategy,
conjunction with accountants?
We do. Yes, we do.
Okay.
Yeah. So Castlemark Wealth Management was acquired at the end of August. And it was acquired by, Croft Financial Group. And they also own a tax firm as well. So there's 3 firms integrated into one. It's been a very interesting acquisition on my part. They acquired me. They were looking for an integrated wealth management platform to compete in this environment. Again, taxation is a huge deal for clients who are coming in that are looking for investment services, as well as portfolio management. They're a full-service portfolio management firm.
One-stop shop. That's
and taxation,
amazing.
yeah.
That's the first time I've ever heard of that.
Yeah, it's an integrated model for them. I'm still acting founder, and I still see clients as a consultant. But after 12 years, I wanted to take some money off the table and spent some more time in the media and on the keynote stage. So I kind of crossed a few different areas, but looking at what the needs are for Canadians overall, it's about how do we become better with our money? And what I truly find is that people already know what to do. We already know we should spend less and we should save more. We already know not to rack up credit card debt. We already know that. So why don't we do it?
I don't know.
Exactly. It's the psychology of money.
It's
Yeah.
Why we relate to money the way we do, how we spend our money, the decisions we make around our money are really the decisions that make or break our financial life.
Is it
and
an-
that,
kind of-
and that comes before the decision of what dollars to put where.
It's kind of similar to how we eat in a way. It's a psychological thing, and we connect emotions to money. So if we're coming from lack, then even if we're making money in some way, we're going to find ways to spend it and then be still in lack, So I feel like that's a bigger issue as well, like seeing your relationship with money.
Yeah, and I think
That's
it depends on your personality, right? So if you come from lack, then you could have you'll have a completely different experience of money than if you come from abundance. There are two different sides of the street. When I was younger, my parents did quite well, and then my parents got divorced. And my dad's business went belly up. He lost his business. The banks called his loans. And my mom was she had a grade 10 education. So we lived for the majority of our teenage years on welfare.
Yeah.
So I come from a very poor upbringing. So I relate to money in a very different way. And when I work and I'm now in the wealth management business, it's almost like how do I create a space for my life so that I don't feel that I'm going to be in a place of lack. So I went to the opposite end of that direction or spectrum. And I'm not saying to your listeners or to you ladies that you need to sit down and try to be psychologists around your money, but pay attention to what you're doing with your money.
The patterns.
Pay attention to the patterns, because I think that what you spend your money on and what you want to spend your money on.
Why are you doing it?
Is a true reflection of who and how you think you are and who you put yourself out into the world. And that needs to align with who you actually are. And I think sometimes people get stuck in that trap of keeping up with the Joneses, right? Like, what's the flashy car? What's the flashy shoes?
Thing.
And listen, I like nice shoes. I like nice cars. So I'm not trying to say you shouldn't do that. What I'm trying to say is be financially responsible with the decisions that you're making. If you want to own a home, if you want to launch a business, if you want to create a strong real estate brand, you need to invest your money in your brand and in your business. And if you're spending all your money on fancy cars and expensive vacations, it's not going to go to where you actually need it to go to create financial security or
long-term
financial
goal?
independence. And that is a psychological conversation you need to have with yourself. Are you willing to delay gratification?
And especially
To
in
be
this
able to have
industry,
something now.
In real estate, you are your image. So it's how you look to the public. Like if you look like you have a fancy car, or you're wearing, name brands or whatever it is, it makes you look more successful. So there's like a psychological piece to that as well.
And there is a branding element too. I mean, I'm in wealth services, right? So
Yeah.
I mean, I'm always, when I'm showing up to clients, I'm always in a suit and I like nice things. But, I think it's about buying one expensive purse every few years. It's about
Yes.
buying a couple of statement pieces that you can have in your wardrobe that have you, not just be successful, but actually be the walk that you talk. You don't need to have 10 jackets that are designer. You don't need to have 15 purses and 12 pairs of shoes. You could be doing that, but for your professional, you don't need to have that for everything. So I think it's just about
Living within your means.
it's not all or none. It's about, so if I'm going to make this decision and it's important for me to show up and be in this designer brand, fine. But what does that look like? And what is that? And this sounds insane. But when I buy expensive clothes, I wear my clothes for long periods of time. I'm like, how many wears do I need to get at this jacket for it to make sense?
Yeah.
Am I going to wear this am I going to wear this once a quarter for the next 5 years? What does that cost look like? I actually amortize my clothes over periods of time in
do
my
the same
brain
thing. I look at
before I purchase it to make sure that
and
I'm
winter
making the
coats
right
are my
decision.
biggest thing for
right?
that.
If it's a specific piece too
It's
that
a-
that everybody's going to see, it's like, okay, well, I can only wear it once here and I can only wear it once over here, because it's like, and then how much are you going to spend on that to wear it once?
Yeah, and again, but you can change it up with a scarf or you can change it up with other things. But that gets down to how you feel about yourself. And if you feel that you always want to have the latest and greatest, that's great. And maybe you can have all those things. But just make sure that your long-term financial security is not being wasted on things that don't provide a lot of value to you in the future. Because every dollar you spend today is a dollar you take from yourself in the future.
I like that.
I have
so
a question. So I know that right now it's a really stressful time in the economy, and people, with inflation, people are spending a lot of money on just the necessities. So some people are having to cash out their RSPs. Is there a way to do that that's smarter? Is there, do you cash it out into your corp, or do you, into your prec, or how do you do that to avoid being taxed at the maximum?
Yeah, so an RSP stands for Registered Retirement Savings Plans. So essentially what that is, it is a tax-sheltered vehicle that you can grow money, tax-deferred until you take it out in retirement. You have to take it out in the year you turn 71. 72, you have to start taking out the withdrawals. The intention of that is to, number one, in the year that you earn income, you could put money into an RSP and you receive a tax deduction, right? So 18% of your earned income up to a maximum amount goes into your account, grows completely tax-free. When you take money out of your RSP, it's taxed at your marginal tax rate, so your MTR. So if your MTR is high, you're going to lose half of that to taxes, right? So depending on what your tax rate is. But if you're in the highest tax bracket, you're going to lose half of that to taxes for MTR. If you're also selling it in an environment where the stock market has also been beat up quite significantly, now you're selling your capital assets at a loss. So you're selling a lost asset. It's like selling real estate when it's a down market, and then you're selling it and paying and then paying tax. So I think it's about understanding if you're in a position where you need to liquidate some RSPs. First of all, look to see, how are your RSPs doing? Are they doing 10%? Are they doing 8%? What's the rate of return on the RSP? What is the net amount you put into it? And what is the value right now? If you take it out, how much will you have to pay in tax? I mean, maybe you had a great start to the year and you have a lousy second half of the year, but you're already at the higher tax income. It may not be the best decision to take it out of your tax-free savings account.
What would be another option then?
Perhaps if you have a spouse and your spouse isn't making a significant amount of money, maybe you look to your spouse to see what is their income tax bracket for the year. I mean, if you have access to a line of credit and the line of credit is, 6 or 7%, but your RSPs have done 8 or 9, then it's a question of, where's the best place to take money from? I mean, a lot of people are looking to their lines of credit right now, hoping that they're putting money on line of credit and they'll see the interest rates fall down next year. Listen, we don't know that's going to happen. We'd like to happen. We'd like to see it happen in the second and third quarter of next year. It could happen. It could not happen. So I think if you're really in a crunch, it's about looking at all of the resources you have access to and then making sure that you are taking advantage of what the best move is after tax. And understanding after losses, because you don't want to be selling a portfolio when the market's down, either in real estate or in the investment industry. So this is where we kind of circle back to our initial conversation of you need to have 6 months at least of money inside your accounts to be able to weather these kind of storms. Because when you sell assets at depressed levels, you're never going to make that money back, right?
That's right.
So it's like a double sting. So this is why it's so important. And I know that people, and it's a hard market. It's a hard market to be in the real estate market. I'm not a realtor, but I have lots of friends who are realtors, and I see it even as in my own real estate holdings. I see the value of the property where it is to where it has been before. And, it's also one of those things like in the stock market, when the market isn't moving and prices are low, that's the time to buy, right? At the maximum point of pain is the maximum point of opportunity, right? So if you have been doing what I've been talking about during this conversation and you have been saving for a property, this is the time to execute, right? So buy things when they're on sale, buy things when they're cheap. When people are running for the hills.
Explain that with regards to the rate, because a lot of people are like, oh, the rates are too high. But I'm like, you know what? What is it? Date the rate, marry the price. Date the rate, marry the price. Right? That's the saying that I don't know.
I've never heard it.
Yeah.
Listen,
like
but you have to be able to afford the payments, right? And are real estate prices going to fall? I have no idea. I mean, are interest rates going to fall? Eventually, they'll probably fall, but it's going to take a few years for that to happen. If that happens, I mean, as we've seen, to see these amount of increase in interest rates is it's unimaginable because it hits every market.
How expensive mortgages are.
Yeah.
Really high mortgages
are very expensive.
No, every other day we have clients telling us that their rates are because they're all refinancing now and they're going from 2% to 7%,
and that's going to get worse.
I think it's insane.
It is, and some people will be priced out of this market. They will not be able to. They'll be forced to sell. So, but I think it's also important to recognize that the government also knows this. I mean, they know the amount of refinances that are going to happen. They have charts on all of these kind of things, not down to the letter, but they understand that people are going to places where they have to refinance at higher rates. But they need to bring inflation down. So until inflation comes down and hits that 2% range with the Bank of Canada, we're going to continue to see pressure on the market, and it's in the market across the board. But on the other side, things like, GICs or guaranteed investment certificates or things that are tied to the fixed income rate. Also, the bond markets are doing well. So there's always two sides to every story. So you just need to look for the opportunities. And if the opportunity for you is not to buy into real estate right now because you're not sure if you can afford those variable expenses, put your money into a tax-free savings account, buy a GIC that has no tax appropriated to it, take your 4% or 3% and then reevaluate it, do short-term if you want to do short-term. You can do short-term GIC ladders, which essentially means buying different interest rates that go higher over the longer term. But again, I think it's about waiting for opportunity and making sure that you can act, but act when you know you have the financial capacity to be able to afford whatever happens in the next, 6 months.
It's education too, right? A lot of people don't realize a fraction of what you're talking about. So this is very informative, I think, for us, as well as probably most of our listeners.
And to know that there's people out there that can help you and can help you plan and problem solve or, figure out what to do in the future. I've been suggesting to clients to team up. You just team up with other people who want to invest. And that way you have 2 incomes or however many, 3 or 4, and then rent it out, put it on Airbnb, make a side income or a passive income that way. There's just ways to do things. And then, as the time goes and the equity grows, hopefully interest rates come down, then you're going to be in a better position.
Yeah, I think with that, in real estate, it's also tied back to that psychology of money, right? Because, some people look at that and say, oh, I could never be a landlord. Oh, I've heard once you get a renter and you're never getting them out, like the Landlord-Tenant Act is too in favor of tenants. It's not in favor of landlords. So you have some people that are not comfortable being landlords. They're not comfortable managing that type of stress within their relationships to themselves or in their relationship with their families. So I think that, like you said, it's about having the education to be able to make those decisions. And I think sometimes people think that they need to have a lot of money to hire a financial planner or a financial advisor, and that's just not the case, right?
Yeah.
So I think by going in and speaking to someone who can help you create your financial path, and financial planning really is that cornerstone of all things that financial planners and wealth managers do, is they create that financial plan that says, okay, let's start backwards. What do you want to be? Where do you want to be when you're 60 or 65? How much do you want to have in investment assets? How much do you want to have in real estate? Then let's work backwards to see, how do we put those things into place? How do we manage your taxes? How do we manage your cash flow? How do we manage your income, knowing that it's variable and it's going to change year over year? How do we put all of these pieces in place so that when you get there, you actually have attained it? Because I think some people right now, they just kind of look with what's right in front of them with no real clear direction. Then they kind of get sidelined to every other area and they lose track of what they really want to do and what's really important to them. So getting in touch with a financial advisor, certified financial planner, so CFP Canada. If you go onto their website, there's a whole list of CFPs. And those people, I am a certified financial planner as well. They do plans even that are just by a plan basis. You don't need to invest assets with them. They could just do a financial plan for you that you can pay fee for service. So if you are struggling with where to go in your future, hire a CFP, get an understanding of where you're going and what you need to do. If you want to take it on your own from there, then by all means, but you don't know what you don't know, right? So I think it's a very dangerous decision to try to be an expert in an area that is so complex, that is so inundated with changes, whether it be taxes or regulation or whatever the different area would be. I mean, we cover insurance, we cover financial planning, investment planning, tax planning, retirement planning, and the list goes on. So, I think it's about getting help and resources and understand that this is actually the smart move to make.
Well, it's how you figure out your exit strategy, which a lot of people that I know at my age range are looking at. It's like, okay, over the next 15 years, what do I need to do if I want to maintain my lifestyle as it is right now?
Exactly.
What does that mean?
Exactly. And especially now that, when you're looking at, what is the exit strategy? But, when you're talking to younger agents as they get in, and again, this is a broad stroke here, if they look at it as a transaction-based business, then their business will never grow to be a service-based business. And the service-based business is where you're going to have referrals from your clients. And that's generally how the most successful real estate agents that I know have built sustainable businesses that can then be sold to other parties. Then they can take their capital off the table and go on with their next stage of their life. And then there's the capital gains exemption from the government. I mean, I took the first $1 million of the sale of my business completely tax-free, almost the first $1 million, because I planned in advance for it, because I use the tax system to my advantage. So when you look at the things and you understand, if I plan this way and I need these many years to structure the sale of my business, what do I have to do in order to make that happen? I mean, the possibilities here, they just create themselves.
I wish we had another 45 minutes so I can ask you how you structured it.
Yeah, listen, these are all I'm only talking about things that are available to every Canadian, right? So you take a look at the small business deduction limit, or you take a look at the lifetime capital gains limit for small businesses. These are all things that are available to people. They're all things that are available within our reach. But if you don't know them, you don't know how to structure them. And this is not the business that you want to look backwards and say, oh, I should have done that 10 years ago. Because if you would have just asked the question then you would have had a different course that you've charted to be able to make a different reality for yourself.
It's huge.
Yeah,
That's
like,
huge.
oh my God.
I did want to ask you as more of like your client list, I'm sure is obviously massive, but what client story stands out to you most that like is almost like a rag to riches, like someone that you're really proud of? You don't have to share names, but maybe explain their profile and where they're at now.
Yeah, I mean, I would. I think there's I have so many different clients that have gone through it, and in the practice for so long. I've had some clients that I've been with for my entire career. So to see people actually graduate, like have their kids graduate from university. I actually had one. I'm trying to think about if I have just one. So I have a client. We're going to call him John, and he's a C-suite executive in the corporate world. Did very well, was part owner of a very large business, and his partners decided that he was no longer welcome in the business and he was ousted. Oh. And when that happens, people's lives kind of go sideways, right? And the first thing that people automatically do is they just sort of, they sort of shut down and they freeze. They're like, hey, what do I do now? And then people start to panic. Like, what do I do now? My reputation is at hand. My money is at hand. My family's finances are at hand. What do I do now? How do I navigate with where I go next? And for me, I think it was really the process of sort of taking him and his family through the conversation around, okay, let's take a look at what you have. What do you actually have? What are your investments? What are your assets? Where do you hold money? What are the different stock options you have coming in? How much do you need to be able to live off for the next year before you have to make any major decisions in your life? Because the last thing you want to do is to make reactionary decisions in periods of time where you have either gone through a significant change, whether it be a divorce, whether it be a death, whether it be a job loss, whether it be a buyout. Making rash decisions are going to lead to places that you probably don't want to be because you're reacting versus intentionally making moves in the right direction. So with this particular client, we went through the year and no major changes were made other than obviously trying to manage through his own psychological issue of what it means to be someone so senior and so high level, and then to be asked to step aside was a really significant portion of my business from the standpoint of, I want to say that, and I think realtors like that, we tend to, we hold our clients' hands a lot, right? Yes. We have a lot of conversations with them about their real life. Mm-hmm. It's about the dollars and cents of it all. But at the end of the day, they look to us to tell them, this is the right decision, or this is what you need to do. Or let me show you what can happen if you do these different things. Mm-hmm. So I think so for me, probably one of the biggest moments for him is that he made it through the year. He now owns a business that's 10 times the business that he had before. And he is in a place that he couldn't have imagined. But in those first few months, the conversation around, do I liquidate my assets? Do I go to cash? Do I buy more real estate? What do I do now? Mm-hmm. How do I save face with my friends, with my family, with my people? Like, what do I do? And putting him in a position where he was able to maintain and they were able to continue with their life, but be able to give him the structure to make decisions, the structure to look at the agreements, the structure to look at the stock options, the structure to look at the accounts. This is an example, in a year, if you're making no money, it's a good time to take money out of an RSP if you're in trouble, because your tax rate would be next to zero, right? So it's about, that wasn't his case because he had so much money coming off of other properties. But it's about, again, looking at the areas in your life and understanding, what is the net here? And not just the net from a dollars and cents, but what's the net from my own mind? How am I going to take this in? And what decisions am I making? And am I making the smartest financial decisions, or am I making emotional decisions based on the circumstance that I'm in?
Well, you also speak at conferences across North America.
I do.
And that's something that you're looking to move more into. Mm-hmm. Is this the kind of stuff that you speak at the conferences? Yeah,
so I spend my time in two different places. I'm a big component, a big believer in financial literacy for women. Mm-hmm. I think that, women, and as an advisor in this business, there's only 17% of advisors are women, right? It's up from 15%, but it's only 17 or 18%. So it's a pretty small number of financial advisors in the marketplace. And when I look at women and I see the collective power of women and the collective earning potential of women, but yet their reluctance to step into understanding money concepts more, and their reluctance to ask for raises or to really step up and to really take control of their financial situation, I think is something that has been happening for much too long. So I focus on women and wealth specifically. So I focus a specific keynote called The Future of Finance as Female, the 5 principles of habit change for financial independence. So I focus on women in financial independence and women in financial freedom. And then I also focus on another part of my keynote. Essentially, I'm looking at a leadership odyssey, which is the intersection of behavioral intelligence, financial intelligence, and emotional intelligence, and how that helps both people and companies optimize their profitability.
Wow.
Have you written a book?
No,
Not yet.
not yet.
Not yet.
It's coming.
I feel like your intro was very, very good for everything that we've heard so far. I'm like, wow, this is a power woman.
Yeah. And listen, I stumbled many times, right? I've stumbled many times in my life, and we all stumble. So I think it's not about, people say that, oh, you're powerful. And I'm like, listen, I came from my jammies with an F45 exercise class this morning. So we all put our pants on one leg at a time. And the times that I've had to fall down and get back up, are the times that define my character. It's the decision to, and a lot of people, when I announced the acquisition of my firm, they were like, what? What are you doing? Like, are you insane? Because, in some people's minds, it's about, you've created such a successful company. Why would you sell it when it's at its peak?
That's
when
exactly
you sell
why.
it.
Exactly. And it's like, and I think but that's the difference between becoming emotionally attached to something and being financially and understand financial assets, is that a business essentially at the end of the day is an asset class.
Yeah.
And it is meant for profitability. It is meant to be able to create my financial future, which I've been working on for the past 12 years. So I think that in my firm or in all of our lives, we need to practice what we preach.
Yes.
If we talk about saving and investing and starting with the end backwards in mind, and we talk about the different things we want to do in our life as not only as women, but as entrepreneurs and as just powerhouse females, because we all are that apparently, we make those decisions for ourselves, by ourselves.
But it's also knowing that you have more value than just this business that you've created. You've created this amazing business, but there's more for you. So you're not only attached, like that's not your whole sense of self or your whole sense of pride, right? That you know that this is amazing, but you're going to continue to grow and continue to create.
And it's terrifying, let's be honest.
Yeah.
Like, it is a little terrifying, right? Like you kind of step out there, and I actually just public announced it yesterday on my social feeds. And you kind of go from this place where you're known in something and you have a certain level of professionalism and experience and credentials and awards and media attention, and then you say, okay, I'm going to start something completely new. I'm just going to go over there and I'm going to start over.
Isn't that exciting though?
Yeah. And that's the thing, is that, what else do we have to do?
Yeah.
Right?
Like you've already been there, done that.
We can all start over at any point. And even if you're starting over and you were forced to start over, what do you want to do? I want to empower women to become wealthy. I want to empower people to become wealthy, and not just my client base. I want to have a bigger stage to help more people handle their money.
You have
That's
a bigger
what I want
intention.
to do. That's what I want to do. I have a bigger goal. And do I know how to do that? Absolutely not.
But you'll figure it out.
You learn through osmosis.
So it's all about one of those things where you kind of, you take a granular approach. But I've also put myself in a position, as I mentioned in this podcast, that, I put myself in a position financially where I can do that now because I've made smart decisions with my money.
Yes.
So now I have freedom.
It's calculated risk.
And that's what we want in life when it comes to money, is we want freedom.
You want freedom. Well, the freedom to be able to do something you enjoy.
Exactly.
Well, I think we should end it off there.
That's a perfect way.
Yeah, perfect. Let's do the little bit of fun so our listeners,
Fun.
Yeah.
You get fun, Robyn, everybody.
What is your favorite GTA neighborhood?
Oh, I would say where I live. So Don Mills, York Mills.
Ooh, love that. So what is your favorite fast food go-to on the road?
If I'm in a healthy mood, I like Freshie. I'm not so healthy, I'm usually Harvey's.
I
I like the grilled
Harvey's.
chicken sandwich from there.
Grilled chicken sandwich
It's
is
really good.
It's dry unless you put something on it.
Yeah, and usually selfish, so that's why it's like Freshie or it's like grilled chicken sandwich, But I do also like McDonald's fries and cheeseburgers too, so.
Oh, wow.
Yeah.
And what makes somebody financially conscious? In a word or
A word.
One word, I'm like, wow, I don't think I can say just one word ever.
I had to spin it because it's usually like what makes an agent rare, but
Yeah.
So what makes somebody in your opinion?
I think it's their ability to be able to look at themselves when it comes to their money. People hold a lot of shame around money. They think they should be doing things differently. They think they should have more. They think that if they could have,
It's a status.
it's a status. So people hold a lot of shame around money, or they hold a lot of, fame around money. They make money mean a lot of things about themselves. And I think people who are truly the most successful people are people that can look at themselves and have their intentions line up with who they are inside, right? I mean, our intentions and our manifestations and our purposefulness in this world is directly tied to our monetary outcomes. So be purposeful, be intentional, and go through your life.
I love that.
Yeah.
Can I clap?
Yeah, no, I feel like we all need to.
Even our producer loved it.
Right? That was
So, and to close off, where can our listeners find you?
So 2 places. So castlemarkwealth.com would be the financial consulting part of it. And then for keynote speaking, it'd be Robyn Thompson Money.
I love that. Thank you so much.
Thank you.
Thanks for
Robyn.
having me, ladies.
No, it's been
Thanks for
amazing.
coming. This is great. So
See you all
informative.
next week. Bye for now.
Thank you.
Thanks for tuning in. Oh, and don't forget to subscribe, like, and comment. Thanks, guys. Bye for now.
you.
Awesome.